Hi, I also have a cheat sheet because I haven't had time to memorize this. Also, I apologize to everybody who only talked for about 12 minutes because I came to win. Okay, so my name is Standridge. I've been in the game industry for about 15 years, primarily as a programmer. Before that, I managed tax preparation offices, which is exactly as awesome as it sounds. I'm going to speak to you tonight on the incredibly sexy subject of income tax, specifically as it applies to small business and self-employed people. So, you seem like a very friendly and non-litigious bunch, but just the same, I'd like to point out that I am not a tax attorney or IRS agent or anyone else who can legally tell you how to do your taxes. I'm just a dude giving some free advice, so please don't sue me. It really won't benefit either of us very much. I'll also note that the first draft of this talk was hilarious, but it was about 30 minutes long, so I had to cut most of the funny, and I'm still going to talk really fast and go over. So, taxes. How do they work? I think we all get the general concept. You make money doing something, and the government takes some portion of it, so we have roads and schools and whatnot. In reality, of course, it's a lot more complicated than that. Once you get outside the comfortable world of W-2s and automated withholding, it gets, fairly complicated, and it depends on you and your business. So let's talk about your business. Why form a business first? Number one reason is probably to protect yourself. If you get an employee identification or employer identification number, an EIN, you can use that instead of your Social Security number. To get paid. Now, this doesn't mean that you don't trust the people that you're doing business with, and they shouldn't take it as such, because you don't have any control over whether they get a virus or donate a laptop without wiping the hard drive or leave their keys at a bar, flash drive and all. Suddenly, you're buying soccer uniforms for someone in Brazil, and yes, that happened to me. I like to think that they did really well that year, and I'm quite proud of them, but who can be sure? Now, that said, a formal business agreement is another really good reason. It can help mitigate a lot of disputes between partners that might otherwise show up. And litigation. If you are working with no formal business structure, your personal assets can be at risk if something goes horribly awry and somebody sues you. So, some business structures provide some form of protection or another against a variety of these things. So I skipped a little bit here. Now that I've convinced you, hopefully, to make an honest business out of whatever it is that you do, what now? Businesses come in a pretty wide variety, to be honest, but when you strip away all the extras, you're really dealing with about 5 basic things. First, the sole proprietorship. Sole proprietorship is incredibly easy to create. If you sit out there and suddenly decide that you have an idea to make money, maybe throwing things at me, you could technically call that a sole proprietorship, and neither of us would be happy because nobody would pay you to do that. But they have minimal costs attached. You, as the business owner, are responsible for and entitled to 100% of the profits, losses, and assets this creates. But at the same time, they have no legal standing, so you are also responsible for 100% of any trouble that they generate. If there's more than one of you, you might consider forming a partnership. Partnerships require an EIN, they don't have legal standing, and they don't require a formal agreement between the various partners, but that said, it's still a good idea if you think you're in it for the long haul. If one person decides they did most of the work and deserve most of the profits, when they don't get that, they might take their ball and go home, and what happens to their contribution at that point? Nobody knows without a formal agreement. Partnerships also offer no real protection against liability, including that of your partner shippers, a word I've probably just made up. You are partially responsible for any spectacular poor decisions they happen to make. So how do you protect against all of this hypothetical legal trouble? Well, there are 2 types of corporations. There's the C Corp and the S Corporation. The primary difference as far as we're concerned is a C Corp has its own taxes and files its own tax return and makes its own profits and loss. And S Corporation just passes all of that through to its shareholders. That's pretty much everything I'm going to say about a C Corporation because they're really way beyond this talk. Corporations have their own legal standing, and they thus provide a shield against liability for their shareholders, which is quite nice. However, there are limitations placed on how they can distribute their expenses, partly because a corporation pays dividends at a lower tax rate than most people's income tax rate. So you can't get away with paying yourself a $1 salary and taking the rest as dividends. The government doesn't like that. Finally, the limited liability company, or the LLC. Like a corporation, this must be specifically created by filing with your state. They offer substantial liability protection to their members, and they pass profits and losses on to their members just like an S-Corp would. They're typically cheaper to operate than a corporation, and there are very few downsides. Just a quick note about how all of these things file. Basically, if there's one of you, you file a Schedule C on your personal tax return. If there's more than one of you, your business files an informational tax return, but pays no taxes itself, except in the case of a C corporation. Then passes those profits and losses on to each member who claim it as a Schedule E on their return. Super interesting, I know. Finally, one more contender for business classification, the hobby. You don't want this, and you don't declare yourself a hobby. The IRS will do this for you if you display a certain apathy towards generating profit. Essentially, this is based on two tests. If you make money 3 out of the last 5 years, you're probably okay, but if it looks like you're fudging the numbers, they still may run what's called the behavior test on you. If you write one non-functional Facebook app in January, write off a trip to GDC, you're probably in trouble. So, as a business owner, you are subject to things that a normal employee is not necessarily subject to, like self-employment tax. What is self-employment tax? Is the IRS just mad at you? No, pretty much everyone pays 15.3% of their wages into Social Security and Medicare. When you're a traditional employee, this is split between you and your employer. They pay half, your half is automatically withheld. That's the part that's not the federal withholding. If you are self-employed, you're responsible for all of this, hence self-employment tax. To offset this extra tax, business owners have far more. By the way, there's a lot up here that I'm not going to say, so read the slides. To offset this extra tax, business owners have a lot more deductions that they can take that employees cannot. There are 4 general categories of deductions, of which I will gleefully cover only the first 3. Sometimes you have to pay for things before your business is actually up and running. These are referred to as startup costs. You're technically not in business yet. To keep people from abusing the hell out of this, there are obviously some limitations. You can't take more than $5,000 in the first year, and the remainder is split over the next 15 years, including that first year. Second, if you don't actually wind up starting the business, you cannot take any of these as deductions. Operating costs are the catch-all cost of doing business. Anything that doesn't fit somewhere else probably fits here. To claim something as an operating cost, it must meet all 4 of these requirements up here. Ordinary and necessary means that somebody in your line of work would use this on a regular basis. Current expense is something that is a recurring cost or something you expect to last less than a year. Directly related to your business should be pretty self-explanatory, but yes, it does mean that games are research for game designers and would be an operating cost. And reasonably priced, you can't get away with claiming a gold-plated hard drive or something like that. Capital expenses, these are the things that you own for your business, your stuff, as George Carlin would put it. Rules of thumb, a capital expense is expected to last a year or more and cost more than $100. You do not deduct capital expenses, you must depreciate them, meaning you recapture the cost of the item over the course of several years. Depreciation. There are 3 primary methods of depreciation. There's really only time to talk about one of them, maybe 1.5 if we're lucky. Traditional depreciation is where you buy something for $3,000 and you get back $300 for 10 years, etc. Bonus depreciation is like that, but bonus-ier. You get back 50% the first year. And then finally, Section 179, that's the one we like. That one is your friend. Section 179, named for its position in the tax code, lets you write off 100% of an asset's costs in the first year. You can't claim over a certain amount this way, but it's been sitting at about $500,000 per year for the past few years. So if you're buying more than $500,000 in a year, you should probably get up here next. Most importantly, it's limited to the amount of net business income you make, but if you have a day job or other wages on a W-2, that totally counts, so that can actually help reduce your W-2 earnings as well. Traditional depreciation, why would you ever use this if Section 179 is so awesome? As you can see, sometimes you just can't use Section 179. Also, some people like to budget their depreciations out so they get a nice smooth flow. I don't really recommend that. Seems like kind of a waste of cash. I really wanted to talk about depreciation methods, but I know I don't have time for that, so just accept that there's the straight line method where you split everything evenly, and there's the accelerated method, which is a front-loaded bell curve. You take more early and less later. So, inventory refers purely to items that are purchased or produced with the intent to sell them. That's really all I'm going to say about that. It doesn't really apply to us, and also I don't really know a lot about it, to be honest. Home office, and this is the last section. Home office is probably it's one of the better deductions that a self-employed person can take for a couple of reasons. To claim home office, you must meet all three guidelines in that first list. Currently in business, really only relevant at the start or the end of your business. The space that you use has to be exclusively for business. You can't use 50% business, 50% personal, and then take half the deduction. It just doesn't work like that. Also, you must meet used for business on a regular basis. The IRS, of course, doesn't provide a guideline for that, so just, common sense is really all they want. You must meet any one of the second list. The easiest one is the second thing in there because everybody needs somewhere to sit and do bills or invoice clients, etc. So there are two methods to calculate what you get for home office, but basically it breaks down to divide your office space by your house space, and that's your business percentage. Direct expenses benefit only your office space, and those are 100% deductible. Anything else is an indirect expense. It benefits the whole house, and you must apply aforementioned percentage to that. It's limited in a given year to the net income that your business makes, but that carries over pretty much ad infinitum until you've claimed all of it, even if you shut down the business. Meals, travel, and entertainment. This was once the holy grail of vague tax deductions. They've been abused for so long that they are now limited to 50%. And note that if anything in entertainment fails one of those first two rules, it's probably actually 100% deductible as an operating cost, so do that instead. And the third one means that you can't, where you involve someone who can benefit your business, you can't just ask your friend to come to dinner with you and ask you about business unless you plan to give him or her business, and I don't mean give him or her the business. That would be a different sort of write-off. Discussion for business must happen either before, after, or during. If it's before or after, then it must be non-trivial but non-specific. If it happens during, then you have to have a specific business purpose in mind. Finally, you can only deduct expenses related to actual business guests, not well-meaning tag-alongs. Transportation. This is the other big red flag item for the IRS, which means extra tickets to the audit lottery. It's past time that I mentioned this, but you should keep good records of everything that you do that you plan to claim, but this is especially true in the case of transportation because they like to crack down on people. But it's also a legitimate deduction, so just keep everything tidy and organized. If you use an app or some other means to record your contracting hours and you do most of that work off-site, you could theoretically use that record and the round-trip distance to backfill a mileage log, but that's exactly the sort of thing that I am not standing up here suggesting that you do. So what can you track? What is a business mile? Business miles are spent traveling to a business location. Primary examples are up on the board. Note that you can mix personal and business miles. If you go to the store and buy tequila and envelopes for your job, business tequila, well done. Also, it's really about the car, not you. It doesn't matter who's driving or if you're even there, as long as your car had consent to go wherever you sent it. Commuting, this is the big part of business miles, and this is super confusing to a lot of people. Typically, if you have a regular off-site office, your first trip away from home to that office is not deductible. Same with your last trip of the day back home. If you have a home office, then your home is your first business activity of the day and your last business activity of the day, so even those are deductible. If you work one contracting job at one place, that's super helpful. To calculate your auto expenses, it's really kind of a no-brainer. You take either the standard mileage rate or actual expenses. Standard mileage rate, you I'm sorry, with mileage, you just multiply your business miles by whatever the IRS says that year. It's 56.5 cents per mile this year. With actual expenses, you track all costs individually and multiply that number by your business use percent, which means you still have to track mileage either way. I think that sounds exhausting. I just take the standard rate. Health insurance, and I'm almost done. Health insurance that you've purchased for yourself or via your business is deductible directly on your 1040. If it's purchased via a business, the deduction is limited to the net profit that that business made this year. If it's purchased by you, then you can decide which of your many and varied business ventures gets that, but it's still limited to the net income from one single business per year. Finally, education. To be deductible, education must meet either of these requirements. You must be maintaining or improving a skill that is required by your existing business, or it must be required to maintain your professional standing, which doesn't really apply to a lot of us, I think. But the first one certainly would. If it is deductible, then pretty much everything about it is deductible: tuition, books, fees, etc., and including travel to get to school. For further reading, if you're interested in looking into any of this more, I recommend nolo.com. They are a publisher who do really nice layman term books on all of this. Most of this talk, I used one of their books for a reference. And that is about it. I'm way over time. I apologize. And also, I don't know if KLRU actually had anything to do with this, but thanks to them anyway. So, thanks, guys.